Dr. Keller here with today's topic, federal interest rates, to raise or not to raise. That is the question. The Federal Reserve is meeting again this month, January 30th, 31st, 2024, to discuss the U.S. economy, and most on everyone's mind are interest rates. In its last two meetings in 2023, the Federal Reserve paused. That is, they did not raise interest rates, nor did they lower them. Historically, after two pauses, the Federal Reserve has always lowered interest rates. However, is this time different? In my previous videos, I discussed how the Treasury bill auctions have been failing. That is, no buyers for the long-term bonds. Our global partners no longer want U.S. Treasury debt, and this is true for several reasons. One is that the world is tired of the U.S. forcing its political military might at will. This is why our global partners are de-dollarizing. And when the USA confiscated and froze other countries' assets at will, the world was watching and no longer wants to do business on the USA terms or put themselves at the mercy of the USA and its dollar as the tool of control. Countries are aligning with each other economically and with the backing of powerful Russian and Chinese military to de-dollarize. Add to the trillions in U.S. sovereign debt. Who would trust that the U.S. government would be able to honor a 10-year bond, let alone a 30-year bond? Maybe 6 months, but certainly not more than 5 years. And with a debt-to-GDP ratio of 120%, the United States is historically on a path of bond default, because no government in history has ever not defaulted once its debt-to-GDP reached 120%. And as my cartoon here explains on the usdebtclock.org, fiat currencies backed by nothing are designed and destined to fail. So it should come as no surprise that the countries that used to buy U.S. treasuries are no longer buying at the treasury auctions. So what would happen if the Federal Reserve raised interest rates? Well, it would become even more difficult to sell its treasuries when the interest rates paid on purchasing a bond drops. How many more bond auctions are going to go no bid? If the U.S. government wants to sell bonds to raise capital, it will have to raise the interest rates to attract that capital. With inflation still high and rising, which is the stated reason the Federal Reserve raised interest rates in the first place. However, inflation was not only due to the U.S. government printing and spending money in the economy, it was due to a supply crisis it created when they shut down businesses due to the pandemic. So to encourage economic growth, the Federal Reserve should have lowered or kept low interest rates. With high interest rates, banks have failed. Banks have stopped loaning money into the economy, creating additional supply strain. This supply shortage has not been resolved, and as noted in previous videos, our global trade partners are no longer shipping product to our U.S. ports in trade for U.S. dollars. Our ports all over the United States country are just about empty. Okay, so what would happen if the Federal Reserve raised interest rates once again this year? The U.S. government would sell even fewer bonds, resulting in a deepening liquidity problem. It's not inflation that the Federal Reserve is fighting, it's really a bond default. Why doesn't the Federal Reserve discuss this openly, or the Treasury or the financial press discuss this openly? Okay, what would happen if the Federal Reserve lowered interest rates? Well, at a time when foreign banks and firms are dumping their U.S. debt, treasuries, lowering the interest rate isn't going to help the U.S. economy. The U.S. would be compounding the no-bid problem on their treasury auctions. Further, the de-dollarization as would-be investors would require a higher return for their risky T-bills, not lower returns. So in a way, the Federal Reserve is in a quandary. Raising interest rates or lowering interest rates, they're damned if they do and damned if they don't.